The bottom line to me is that all of these movements, these knockdowns, the suppression, the continuing suppression in the gold market or the volatility is being met with, thank you very much, we'll stand for delivery. And that's what we're seeing, whether it be tremendous silver deliveries in India or massive gold deliveries in China, or the rumor that now China is going to be accumulating copious amounts of silver. They're doing it in ways, in every way, whether it be exchange for physical, whether it be share redemptions out of the ETFs, whether it be direct deliveries out of COMEX or the LBMA. They're buying everything they can that is not nailed down. This is a much bigger game.
In a bold move amidst ongoing geopolitical tensions, a Russian court has ordered the seizure of approximately $440 million from JP Morgan. This marks a significant escalation in the economic standoff between Russia and Western nations, with potential repercussions for global financial markets. As a major player in the banking sector, JP Morgan's entanglement in this situation highlights the broader risks faced by financial institutions amid such geopolitical strife. The action against JP Morgan could potentially disrupt international banking relations and affect global market stability, given the bank's significant role in the global financial system. Furthermore, this incident is influencing the precious metals market, with notable increases in silver investments, particularly in Asia. Countries like China and India are ramping up their holdings, reflecting broader concerns about currency stability and economic sovereignty in the face of Western financial policies. This situation underscores a possible shift towards more aggressive use of economic tools in geopolitical conflicts, signaling a new era of financial warfare. Investors and financial analysts are now closely monitoring how these developments might reshape international economic relationships and market dynamics. The interplay between geopolitical actions and economic outcomes is becoming increasingly complex, reshaping the landscape of global finance. Now we'll show you the best clips of the latest interview. Make sure you watch the video to the end to make the most out of it. Enjoy the episode.
Diminishing in terms of its geologic footprint and in terms of above ground stockpiles. And you add into it the rumor that because gold for immediate delivery in China is becoming harder to get, that they have moved and prodded, they being the government, and telling their people who have an affinity for buying gold on a habitual basis to look to silver. The investment demand for silver in places like China and India, who continues to blow off the doors. Their numbers are up like 280% month over month. They bought almost 500 million ounces in the last 2.5 years. It's as undervalued of an asset as you will ever find. But when we also talk about gold, I want to bring something up kind of interesting that is lost in the pullback, in the smashdown. And, you know, when the market was smashed in gold last week or the Thursday before that, and, you know, a couple $1 billion worth of metal dumped onto the market like that in a matter of just, a handful of minutes or less. Well, that's not the way trades are done. You don't maximize anything by dumping it into the thinnest part of the day when New York is closing and as it's transitioning, to Asia. You're guaranteed the worst settlement, but you are guaranteed the greatest effect. It's a drive-by shooting. But when you look at the amount of COMEX-approved gold bars in Hong Kong that are being delivered to Brinks, Hong Kong. Brinks has a deal with the COMEX, and it's through the OTC market, where over the counter, where the buyer and the seller can negotiate where to take delivery of the product. And so what we've seen a tremendous amount of in one day last week, 475 gold kilo bars. Pardon me. That's what was received into the depository. 7,560 kilo bars were shipped out to Brinks Hong Kong. That's $571 million worth of gold, or 243,000 plus ounces. But the interesting thing about it is that the majority of all the physical movement through the Hong Kong vault is caused by EFP transactions, exchange for physical transactions. And basically what happens is that they knock down the paper price, they buy the real thing and stand for delivery in Hong Kong. These bars are then picked up and moved directly to the Shanghai Gold Exchange. So what we are seeing again is the awareness of the Chinese and the big players across the globe that when the price gets knocked down, they'll stand for delivery. They will immediately stand for delivery. They will buy contracts and stand for delivery and have them moved in kilo bars to Brinks, Hong Kong, which is then picked up by a truck and delivered right to the Shanghai Gold Exchange. The same thing is true with silver, and these exchange for physicals are much more difficult to see with transparency. So
in today's market recap, silver price falls to 3-week low near 26.70 with eyes on Fed policy meet. Silver price tumbles to 26.70 as U.S. yields rise ahead of Fed policy. The Fed is expected to keep interest rates steady with hawkish guidance. Investors should be prepared for high volatility this week as the U.S. non-farm payrolls will follow the Fed's policy. The white metal faces a sharp sell-off after breaking below the crucial support of 27. The asset faces pressure as the U.S. Treasury yields rise amid caution ahead of the Federal Reserve's monetary policy announcement on Wednesday. The U.S. dollar index, which tracks the U.S. dollar's value against 6 major currencies, bounces back to 105.90. The U.S. dollar's appeal improves ahead of a data-packed week. This week, investors will focus on the ISM manufacturing PMI and the non-farm payrolls NFP report for April, which will be published on Wednesday and Friday, respectively. Now we'll show you the best excerpts of the latest interview, but first, hit the like button, smash the subscribe button, and turn on the notifications bell so you do not miss out on our daily videos. Enjoy the episode.
The bottom line to me is that all of these movements, these knockdowns, the suppression, the continuing suppression in the gold market or the volatility is being met with, thank you very much, we'll stand for delivery. And that's what we're seeing, whether it be tremendous silver deliveries in India or massive gold deliveries in China, or the rumor that now China is going to be accumulating copious amounts of silver. They're doing it in ways, in every way, whether it be exchange for physical, whether it be share redemptions out of the ETFs, whether it be direct deliveries out of COMEX or the LBMA. They're buying everything they can that is not nailed down. This is a much bigger game. And when you look at the combined average daily volume now between the Shanghai Gold Exchange, which is largely cash and carry, and the Shanghai Futures Exchange, effectively you now have Shanghai as the second largest gold trading market on the planet. They have taken over the COMEX in terms of trading volume. And I do believe there will come a time when these bullshit drive-by shootings that we see, that there isn't a trader on the planet that would do things that way that wasn't trying to create a tremendous amount of effect. If they were trying to maximize the transaction, it would have been bled out over hours or days or even longer, not dumping a few $1 billion over the course of 2 minutes to drive down the price at the end of the trading day. That is the dumbest thing you could ever do. That trader would be shot and then fired, probably in that order, unless they were doing it for a reason. And that is being met not only with, we'll stand for delivery, thank you very much, but also in terms of legitimacy and trading volume in Shanghai. We can see that it effectively has taken over in terms of volume, the COMEX. Now, does that last? Does that become greater? Maybe it does. In an environment where right now Shanghai is pricing silver $3 an ounce higher than the COMEX is, maybe the world understands. And I've read that to you, the finance ministers of Russia talking about the new BRICS currency, saying that, for the moment, the prices are determined in the West, even though we produce and consume these commodities, the West prices it, but that will change. The new system will change that. Or the head of the Shanghai Gold Exchange says, when we finally have the right to speak in the international gold market, the true price of gold will be revealed. And that stands for silver too. But So these ups and downs, they don't mean anything. And the technical analysis, sure, there are still traders and algorithms that follow that. But the bigger issue is that the countries that are accumulating it, they're using it to their advantage and they are emptying the shelves. And so when you see a pullback, either you can chase the pullback and add to your position, or you can think that maybe the trend is over and it's going to head lower, because we've all been conditioned into believing that. It just feels to me that this time that's not the case. This time, each pullback is met with demand and met with a rising price or a stabilizing price. In years past, when they would hit it hard and it would fall, not just a little bit, but a lot and for a long period of time. And they would then step on it again. So you didn't have any aspirations of it coming back up until they decided to let it rise up and let the speculators back in and get a little hope. But it just seems a little bit different this time. And I know that's a dangerous thing to say, but that is how it feels to me, Chris. And I think the rest of the world, these countries in particular that are using the suppression against us, well, they'll continue to do that until there's no one left to deliver at the make-believe prices of the West.
Well, I hear you, and certainly.
More market news. Silver miners face a critical need to transition to more sustainable and efficient operations. A leading industry analyst says in a report on how silver miners can build long-term competitiveness as they transition towards a greener economy. He explores the challenges and opportunities they face from the growing demand for clean energy initiatives and looming supply deficits. Demand for silver from the industrial sector grew year on year by 8%, with continued investments in energy transition initiatives, in particular from the growth of solar energy initiatives, and that this is expected to further grow over the coming years. Aside from silver's use in jewelry, the rise of solar energy is the main driver of the rising demand for silver. In addition, sustainable mining practices and circular economy initiatives will remain key focus areas for miners to align with ESG considerations. Focus on digitalization and automation will be crucial for silver miners' long-term viability. Now we'll show you more clips, but remember to subscribe to the channel and check our pinned comment for some massive sign-up bonuses if you plan to add crypto to your commodities portfolio. Enjoy the episode.
Statistics don't look good, like unemployment or inflation. Just change them. We'll just adjust the metrics. We're a country that in many respects has lost its bearing, and this is not lost on the rest of the world. We've talked at length about all the other things that is happening here in this country. It's not lost on the rest of the world. And so, yeah, I think by sanctioning, you are only incentivizing, you are creating a rallying cry, you are telling all of these countries, this is your chance to find safety in numbers. And you would think that they would understand that, which is why I feel that this is almost too stupid to be stupid, that it just seems like it's happening. It's real. And as my buddy Chris Irons says, you know, they're here they are trying to tax unrealized gains, right? On people who are making big bucks, like over 100 million a year. Well, these are the people that create all the jobs. These are the people that can pick up and say, screw off. I left Minnesota because it lost its mind, right? And that was a big deal for me. Come to Florida. These are the people that will pick up shop and leave the United States. And before they do that, they will sell everything they have in NVIDIA and in Bitcoin and in all of these assets that have unrealized gains to float an idea of taxing unrealized gains as about as un-American as you could ever get. It's as uncapitalist as you could ever get. And it will destroy the markets. And more than anything, it will make these people leave. And then when these people leave and pull with it all of the business that they were creating, the industry that they were creating, who's going to fill that vacuum? And it's just like the commercial real estate that we see. You know, listen to some of these numbers on commercial real estate real quick. I know that's not what you asked me, but it's all part of a bigger picture. Let me just show you these numbers. They're absolutely scary as hell. There were 625 commercial real estate foreclosures in March, from up 117% from the year before. I'm just going to give you three of them to give you an idea. And this is kind of the same thing when you talk about the sanctions and the ramifications of people leaving the system. It's the same thing that's happening in the cities. The former One AT&T Center, which 44 stories, the third largest building in St. Louis, sold for $205 million in 2006, just sold for $3.6 million. It sold for $205 million in 2006. Holiday Inn Express in Washington, D.C., debt owed to the lender. The lender was the only bidder for the foreclosure. The lender. And they bid $18.5 million for it and won it. It was originally sold for $83.5 million just a few years ago. And the last one, Blackstone sells NYC office building at a $420 million haircut. $185 million they bought it for. Blackstone paid 600 or sold it for, paid 605 million plus millions in renovations in 2014. It's all the same thing. You push things too far, and the consequences, in this case, what happens to the cities and the lenders when all the commercial real estate goes belly up. But what happens when you chase everyone out because of your sanctions? They move away from the dollar. Big problems. You chase out the people because of unrealized capital gains and raising capital gains tax to 44.5%. You're going to blow things up and chase people away. The consequences of our politicians, whether it be by weaponizing the dollar or destroying the dollar or just allowing our inner cities to be destroyed, they're all the same problem in a different shirt. And that is the consequences are people will leave. And that's what's going to happen with the big money. That's what's going to happen with the people that have been accepting dollars for all of these years. They're not going to anymore. And that's why you see them all dumping treasuries and buying gold, because it has no counterparty risk. And that's what's putting the floor under the price of gold, as the public in this country has been selling into the rally and selling their ETFs going down at a 45-degree angle, even though Bill Holter thinks a lot of that is share redemptions. That's why the money's leaving the ETFs. I think a lot of it is that there's just not enough belief by the public that gold and silver are the place to be. Instead, Nvidia and Bitcoin are much sexier. You trigger a law like this where unrealized gains are taxed, it's game over. Just like it is when you start to weaponize the dollar across the globe by a country that is viewed as being incredibly hypocritical and rightfully so. They're going to leave, and there are consequences to pay. So whether it's in the inner cities or the dollar around the globe, the same thing is true. You mess with things the way that we are, and there will be consequences for sure.
Well, then I guess JP Morgan getting one of those consequences.
What do you think of Schectman's take? Is he spot on, or will he blunder his prediction once again? But most importantly, are you bullish? Post in the comment section if you're bullish despite the massive sell-off, and watch this video right here because it's a perfect fit for you. I see you on the other side.